Hello friends, derivatives are known as an antidote for deepening stock markets. Let's discuss them in details. Derivatives are products whose value is derived from the value of one or more basic variables called bases. It can be underlying asset, index or reference rate. The underlying asset can be equity, forex, commodity or any other asset. For example, wheat farmer may wish to sell their harvest at a future date to eliminate the risk of a change in price by that date via derivatives. Factors driving derivatives growth. First of all, increased volatility in asset prices in financial market, increased integration of national financial market with international market, innovation in derivative markets which optimally combines the risk and return over a large number of financial assets, leading to higher return, reduced risk as well as transaction cost as compared to individual financial assets. So who are the participants in the derivative market? First of all, hedgers face risk associated with price of an asset. They use derivative market to reduce or eliminate this risk. Speculator who wish to bet on future movement in the price of an asset, derivative contract can give them an extra leverage. Arbitrageurs are in a business to take advantages of discrepancy between prices in two different markets. They will take offsetting position in two markets. Let's go through popular types of derivatives. First of all, forward. A forward contract is a customized contract between two entities where settlement takes place on a specific date in future at today's pre-agreed price. Future. A future contract is an agreement between two parties to buy or sell an asset at a certain time in the future at certain price. Future contracts are special types of forward contract in the sense that the former are standardized exchange traded contracts. Options are of two types, calls and puts. Call gives the buyer right but not the obligation to buy a given quantity of underlying asset at a given price on or before a given future date. Put gives the buyer the right but not the obligation to sell a given quantity of underlying asset at a given price on or before a given date. Warrant. Options generally have life up to 1 year. The majority of options traded on option exchanges having maximum maturity of 9 months. Longer dated options are called warrant and are generally traded over the counter. LEAPS. Their acronym is long term equity anticipation securities. These are options having maturity up to 3 years. Baskets. Basket option are option on portfolio of underlying asset. Underlying asset is usually moving average of basket of assets. Equity index option are a form of basket options. We will now discuss the two most popular types of derivative, future contracts and option contracts. First of all, future. Important features of future contracts are: forward and future market gives you a financial benefit if you have an accurate directional view on the price of an asset. Future contracts are an improvisation over forward contract. Future prices generally mimics the underlying price in the spot market. Future contract is a standardized contract wherein all variables of the agreement is predetermined. Future contracts are time bound and the contract are available over different time frames. Most of the future contracts are cash settled. Lot size is the minimum quantity specified in the future contract. Contract value is equal to lot size times the future price. To enter into a future agreement, one has to deposit a margin amount, which is a certain percentage of contract value. Every future contract has an expiry date beyond which contract would cease to exist. Upon expiry, old contracts cease and new ones are created. Let's understand the impact of leverage through future contract. For example, we have a capital of 1 lakh which we want to invest in State Bank of India. Buy date is 12th March. Buy price is 250 per share in both the markets. Quantity that can be bought in cash markets are 400 shares. The lot size in future market is 3000 and margin requirement is 13.33%. So contract value per lot is 7.5% and margin deposit per lot is 1 lakh. So by investing 1 lakh we can buy only 400 shares in cash market but can buy 300 shares or one lot in futures market. For example, the sale price has increased to 255 per share in 14 days. So sale value in cash market is 1,02,000 and future market is 7,65,000. Profit earned is 2,000 and 15,000 in these respective markets. There is a huge variation in the absolute return for 14 days, which is 2% in cash market and 15% in future market. Here we have presented only the upside. Similar is the effect if a trade goes against our wishes, and there will be leveraged effect on our losses. By virtue of leverage, a small change in underlying results in a massive impact on profit and loss. Option value depends on following 6 factors: market price, strike price, volatility, time to expiry, interest rates, and dividends. There are popular option Greeks which play a significant role in option valuation and trading. First of all, delta. Delta is the rate of change of option price with respect to price of underlying asset. Gamma, rate of change in options delta with respect to price of underlying asset. Theta of portfolio is the rate of change of value of portfolio with respect to passage of time with all else remaining the same. Vega of portfolio of derivative is the rate of change in the value of portfolio with respect to volatility of underlying assets. Rho of portfolio is the rate of change in the value of portfolio with respect to interest rate. Generally, investors do not take a naked position in an option, but they do option trading through option strategies. Popular types of option strategies are writing a covered call, where you hold underlying share and sell call option with an objective to earn call premium. Protective put, where you hold underlying shares but buy a put option to provide protection against fall in the value of underlying shares. Bull spread, where you buy one call or put option at low strike price and sell at higher strike price and want to benefit in a limited manner for bullish view. Bear spread is the exact opposite of bull spread, when you have a bearish view. Straddle is where you sell a call option and put option at the strike price. Strangle is when you sell a call option and put option at a different strike price on the same underlying. You can have a long straddle and strangle as well as short straddle and strangle. Combination other strategies involving put and call. Thank you.